these new VAT refund rules are contained in the VAT regulations of 2017. And now, under these rules, KRA requires that all people who export goods, for example, companies, have now to prove beyond doubt that actually goods reached their destination markets. And part of the documents that they want to get from these importers is that they give certified copies of maybe invoices showing that they actually supplied and the goods did not find their way back into the country. You know, there have been those cases of people who actually say they exported, but instead the goods are exported internally, which actually doesn't qualify them to be exports. So as much as this may help businesses, KRA, to avoid losing revenue, it also poses a risk to businesses in terms of their ability to get such refunds, because it may require that one maybe gets in touch with the people that they sold goods to be able to get such documents. And you know, such documents can only be found at the destination markets. So it actually may increase the cost of doing business for those who actually want to get such refunds. And as we speak, according to the data that was given by advisory firm KPMG, they say that despite having ended last year with outstanding VAT refunds of about 14 billion, it now stands at 20 billion. So probably there are those fears we may go back to the highs of maybe 30, 32 billion that we saw way back in around 2013. So what is the actual impact when KRA delays to give a business its refunds? First thing, you find that such refunds lock the capital that a business may want to use for expansion purposes. And then secondly, with such delays, and at the same time we see that businesses that trade with government experience delays in getting their money from them, then added to the current situation where credit to private sector has somehow slumped, then we are talking of a scenario where businesses will really struggle to get capital for them to unlock whatever opportunity that will come their way. Then secondly, for those businesses that may also maybe initially have had good intentions, always paying tax on time, it somehow demotivates them, because picture this, that you are the one giving out this revenue to KRA, but when it comes to you getting refunds from them, because refunds were introduced as a way of trying to help businesses to reduce their costs of production and make them competitive. So in the absence of that, that spirit of competition actually is also hindered. That maybe you are talking about the scenario we saw, maybe having a supplementary budget 3 months into the start of a new financial year, which maybe if you're going back, it may be an unprecedented move, and we saw new tax measures actually being introduced. The first thing that may have caught my attention was that this is a government that starts planning its planning process way back. For example, the budget for the 2019-2020 financial year has already started, and we are only talking of the month of October. It started last month. So we expect that by the time they read out the budget at the end of June next year, it's actually a well thought out plan and within the spending patterns. But look at the scenario that happened in this case, where just 3 months after the beginning of our financial year, we have new tax measures being announced. These ones, maybe they present that potential to even poke holes into the ability of the government to plan for its expenditure. And maybe I see it as a way of a sort of a knee-jerk reaction to say, hey, look here, maybe we had really planned beyond our means and we are only trying to come back to our level. But now the thing that is likely to hurt the common mwananchi is the new tax measures. And even for businesses that had already planned, you plan as a business based on the environment that you are likely to experience. So when new tax measures are introduced along the way, it's out to hurt even the momentum of business. Already we have seen that on the stock market going down. Talking of, if you had talked to traders way back in February, they were even optimistic. Up to the end of the first quarter, they were thinking of really high returns, but introducing taxes like Robin Hood tax and later on dropping them and introducing now doubling the tax on money transfer has also really hurt the momentum of the businesses. So such uncertainty not only just adds a burden to those doing business, but it also introduces uncertainty in the markets. I'll say that looking at the new tax measures, it now even expands the definition of dividends to include anything and everything that a business uh, spends on its shareholders. For example, now even the umbrellas that we may have seen in popular in AGMs being given out to shareholders, it will be treated as an expense. And the moment you incur any cost to a shareholder, then you'll have to pay a tax on it. The same thing may happen to the bonds market. We know that traditional infrastructure bonds have been tax-free. So for companies that invest in such bonds, they expect that since it's tax-free, they're able to get a higher return. But now with the expanded definition, and companies don't own all the money. Sometimes they reach out to people, they put together the money, then invest as a single unit. So that requires that once you get a return, you distribute it back to the owners of the money, of course with a return. But since this tax, the expanded definition of dividends has set in, then that will mean that as a business, you invest in an infrastructure bond, get the return, then at that point you don't actually pay any tax. You keep it in your books. But on the day that you decide to distribute it to your shareholders, you'll have to pay a 30% tax on that. So then the question will be, why should companies go all that way and invest in such bonds instead of maybe just leaving it upon individuals to invest, get that money and hold it to themselves? That's the only way maybe they can go around escaping that 30% tax. But as individuals, they will still have to pay withholding tax, which is also another cost that traditionally they knew that for an infrastructure bond, it was not a requirement. Yeah.